The vicious circle of selling continues on world equity markets, and the global banking system is at the centre of it all. Banks in the UK are facing tough new restrictions, French institutions are sweating on a possible credit ratings downgrade, and German banks may be bailed out to facilitate what's been described as an orderly Greek default. In the US, banks are cutting costs and thousands will lose their jobs, and Australian financial institutions also face similar challenges. Here's Philip Lasker.
Some investors were buying shares today, but the banks weren't a major target. They're the victims of a global unease surrounding financial institutions and a shortage of deposits.
Which means they have to borrow money overseas, and the cost of debt has escalated sharply following the Eurozone crisis. That creates a perception of vulnerability. Over and above that, international investors, they think about things in US dollar terms, and the Australian banks are in A dollars, which is a risky currency. So as you see risk on, risk off, the Australian banks go up and down like a yo-yo.
In the UK, the government is forcing banks to build a firewall between their consumer and riskier investment banking operations.
It would help insulate vital UK retail banking services from global financial shocks. That's particularly important for us in the UK, given the way that major UK banks combine retail banking, high street banking, with global wholesale and investment banking.
The retail banking operations will have to hold the capital equivalent to at least 10% of loans.
What's being proposed today is certainly a higher requirement on UK banks than elsewhere, and that will add a cost to doing business and banking in the UK.
Across the English Channel, the concerns were quite different as investors worried about a Greek default, leaving French banks vulnerable. Speculation that at least 3 major banks holding Greek debt may be downgraded had investors facing a new reality.
We need to realise that yes, Greece should default on an important portion of its debt. Until now we were trying to mask this, so the fact that we are realising it suddenly, we think, all this money that we spent, has it really helped, and how much more do we need to put in? And especially, what will be the bill for European banks at the end?
Even away from Europe, the finance sector is coming to terms with the slow growth environment. The Bank of America plans to cut 30,000 jobs in coming years, and analysts say Australian banks will have to do likewise after the years of strong credit growth.
It was pretty easy to be a banker. You had amazing revenue growth, and because credit was easy, you didn't really have any loan losses. The new world going forward, that all reverses. The only lever they've got left to pull is basically cutting costs. If we were to go back to the late 90s, they actually closed and rationalised their branch networks. The only thing they can really do this time around is to really rationalise their processing costs on the back end, and unfortunately that probably equals some pretty savage job cuts.
At least credit ratings agency Standard & Poor's, which caused so much heartburn for America and global upheaval by downgrading the US, is not stirring up a similar controversy here. In its assessment of Australia, it expects the country's recovery to continue, but warned the pickup could be derailed by the global upheaval.